Hello everyone, so welcome to the first topic for the strategic cost or managerial advisory services. Our first topic is managerial accounting concepts and principles. So before we begin, we'll have an introduction by giving you a glimpse of Washburn guitars. So Paul Stanley, guitarist for the legendary rock band Kiss, has entertained millions of fans playing his guitar. His guitar was built by quality craftsmen at Washburn Guitars in Chicago. Washburn Guitars is well known in the music industry and has been in business for more than 120 years. Staying in business for 120 years requires a thorough understanding of how to manufacture high-quality guitars. In addition, it requires knowledge of how to account for the costs of making guitars. And so, as an example, Washburn would need cost information to answer the following questions. First, how much should be charged for each guitars? Secondly, how many guitars does it have to sell in a year to cover its costs and earn a profit? Third, how many employees should the company have working on each stage of the manufacturing process? And lastly, how would purchasing automated equipment affect the costs of its guitars? So this will all be answered in this subject, managerial advisory services. So I'm hoping that you've had already your cost accounting in the previous semester, so it will not be hard for you to understand the concepts that I'll be introducing later on. So let's proceed now with the management accounting concepts and principles. So first, we'll go to the examples of managerial accounting information. So first is classifying manufacturing and other costs and reporting them in financial statements. Second is determining the cost of manufacturing a product or providing a service. Third is estimating the behavior of cost of various levels of activity and assessing cost-volume-profit relationships. Third is evaluating operating performance using cost-behavior relationships. Next one is planning for the future by preparing budgets. Next one is evaluating manufacturing costs by comparing actual with expected results. Third is evaluating decentralized operations by comparing actual and budgeted costs as well as computing various measures of profitability. Next is evaluating special non-decision-making situations by comparing differential revenues and costs and allocating product cost using activity-based costing. Evaluating alternative proposals for long-term investments in fixed assets. Evaluating the impact of cost allocation and pricing products and services, and lastly, planning operations using just-in-time concepts. So all of that would be discussed in this subject. Okay, so you need to have a knowledge in cost accounting for you to be able to understand this one, and it's very important for you to grasp the idea on how things are done so that it will be easier for you to interpret, and it's very important for you to understand the given formulas or given structure for each and every item that we will be discussing later on. So now we proceed with the difference of financial accounting and managerial accounting. So as you can see here, we have this table here. So for financial accounting, the reports is in a form of financial statements, while managerial accounting would result to management reports. The users of information for financial statements are external users and company management. When we mean external users, those are stakeholders that would need to know the situation of the company for decision-making process. And aside from which, this refers also to the Bureau of Internal Revenue, Securities and Exchange Commission. For banks, it also involves the Bangko Sentral ng Pilipinas, and other organizations. But as to managerial accounting, which yields management reports, those reports are only for management purposes, only for decision making of the management. So financial statements, it is very objective, while management reports is both objective and subjective. It's subjective in a way that it has certain explanations that would actually need the opinion, the professional opinion of the preparer. So for financial statements, it should be prepared according to generally accepted accounting principles, while for management reports, it would be prepared according to the needs of the management. So it would be the management that would dictate how the report would be done or made. For financial statements, it would be prepared at fixed intervals, while management reports may be prepared both at fixed intervals and on as needed basis, because management reports are the types of reports needed for making management decisions. So the focus of reporting financial statements is usually company as a whole, and while management reports focuses as a whole and may also focus on a specific segment only. So it really depends on the need of the management. Okay, so let's look into management accountant in an organization. So so in this case, this is headed by president and CEO. So on top of that is still the board of directors. So the department may be viewed as having either the line responsibilities and the staff responsibilities. So when you talk about line department, these usually they are directly involved in providing goods or services to the customers of the company. In this case, in this specific example, this is from Callaway company. So the line department would be referred to as that by the senior vice president for equipment, plant manager in Chikopi MA plant, senior vice president for Callaway brand, and managing director of Callaway Golf Europe. So the individuals in these positions will be responsible for manufacturing and selling Callaway's product. So the staff department usually provides services, assistance, and advice to the departments with line or staff responsibilities. So a staff department has no direct authority over a line department. So for Callaway, the following are staff positions: the senior VP, chief administrative officer, the vice president of human resources, the chief financial officer, and the controller. Okay, so as you can see here, those are the different departments. Okay, in most of the companies, the controller is the chief management accountant. So the controller's staff consists of a variety of other accountants who will be responsible in specialized accounting functions such as systems and procedures, general accounting, budgets and budget analysis, special reports and analysis, taxes, and cost accounting. So actually, experience in managerial accounting would be an excellent training ground for senior management positions, because accounting touches all phases of a company's operations. Okay, so let's proceed with the next slide. So the next slide is managerial accounting in the management process. So actually, there are five management basic phases. So these includes planning, directing, controlling, improving, and decision making. So when you say planning, management will use planning in developing the company's objectives and it into translate these objectives into courses of action. So an example for this one is the company would set an objective to increase market share by 15% by introducing 3 new products. So the action to achieve this objective might be through increase of advertising budget, opening a new sales territory, or increase the research and development budget. So there are 2 types of planning at this stage. So it may be either strategic and or operational. So when we say strategic, this is this is a set of long-term actions to achieve the company's objectives. So this usually involve 5 to 10 years. When we say operational planning, this develops short-term actions for managing day-to-day operations of the company. So you should be able to determine whether the plan of yours is either strategic or operational. Next concept is directing. So this is the process by which managers run day-to-day operations. So an example for this one is a production supervisor's efforts to keep the production line moving without interruption or downtime. So a credit manager's development of guidelines for assessing the ability of potential customers to pay their bills is actually also an example of directing. However, when we talk about controlling, this is the monitoring of operating results and the comparison of actual results with the expected results. So this is a form of feedback which allows management to isolate areas for further investigation and possible remedial action. So it would also lead to revisions in future plans and things like that. Next one is improving. When we say improving, since a feedback has been used in controlling, so feedback is also used to support continuous process improvement. So this is the philosophy actually of continually improving employees, business process, and products. So this is used to eliminate the source of problem in the process. In this way, the right products and services will be rendered to the right quantities at the right time. Okay, and lastly, the decision making, which is inherent in each of the preceding management process. So when you manage a company, management must continually decide among alternative actions. So managerial accounting supports managers in all phases of the management process. So an example for this one is accounting reports comparing actual and expected operating results help managers plan and improve current operations. So such a report might compare the actual and expected cost of defective materials. So if the cost of defective materials is unusually high, management might decide to change suppliers. So those are the 5 basic management process. So as you can see in the illustration, feedback, the results of plans are important. Actions is part of what is helping this process go smoothly. Okay, so let's make brain exercises for this one. So since we'll only talk about 3 management process for this example: planning, controlling, and improving. So you would need to match the proper phasing. So A meant monitoring the operating results of implemented plans and comparing the actual results with expected results. B rejects solving individual problems with temporary solutions that fail to address the root cause of the problem. And C, used by management to develop the company's objectives. So I'll give you 10 seconds, okay, 15 seconds perhaps, to think of your answers before I'll give away my answers, okay? So have you thought already of your answers? So actually, planning refers to letter C. It is used by management to develop the company's objectives, while controlling refers to A, monitoring the operating results of implemented plans and comparing their actual results with expected results. And lastly, improving refers to B. It rejects solving individual problems with temporary solutions that fail to address the root cause of the problem. Okay? So we'll be ending the first video for this one, and I'll continue with the next slide after this. Okay? So see you in the next video.